Okay, so marginal gains today, and it seems as though where there were active trades, they were in favor of the banks, particularly blue chips like Equity Bank, and also some interest in Cooperative Bank as well.
Yeah, I think with the banking stocks, we saw some sales last week, and the sales last week were basically due to fears on investors' part about the effect of the yield, current market yields and interest rates on second half earnings. Given that we almost have an inverted yield curve, I think there are going to be pressures going forward on interest rate spreads, because we are seeing deposit rates rise as T-bill rates rise, and this could be affecting banking sector interest margins. So I think we saw some sales last week, and also more sales this week on the banking sector stocks. But I think now some investors could be seeing some value, especially on counters like Coop, which have dropped significantly, and that's where they're getting in right now.
I mean, let's talk about the banks, because obviously they're impacted by the inflationary environment and also the rising interest rates, as you've spoken about, and also impacted significantly by the exchange rate volatility, because, you know, it raises questions about the profitability of the forex market and whether or not they should be taking dollar positions at this particular time. The earnings from banks, what are you expecting going forward in terms of full year results? Because the first quarter we saw stellar growth, some really significant performance on the part of the banks.
I think going forward, the key things, it's a mixed outlook. With regards to the interest rate spreads, as I had mentioned, the rising T-bill rates don't really bode well for banking stocks, because right now people with cash are going to banks and demanding very high interest rates, as high as 15% on short-term fixed deposit accounts. And this is going to put significant pressure on the interest rate spreads. If you look at first half earnings from banks, what really helped banks make some profits was their deposit expenses were really low. And I think going into the second half, that is expected to be overturned, and with significant deposit expenses. With regards to the forex trading, it depends on, I think it's going to be a case-by-case basis, because some banks took early dollar positions and bought dollars when they are 95 to the shilling. And some banks may have bought them late. So it really depends. It's a case-by-case basis with regards to forex.
All right, let's talk about that shilling. Obviously, still quite weak at 106 shillings to the dollar. And that's despite a significant interest rate hike in the last week. I mean, what are the options available for authorities right now? They've done everything by way of interest rates. They've done a lot on the interbank market and, moving the discount window rate. We're seeing some commitments on the fiscal side in terms of government talking about their contribution by reining in spending and those sorts of things, but nothing is abating.
I think a rate hike was not really expected to impact on the shilling. The rationale for the rate hike was that we'd see more foreign currency flowing into the country, demanding the shilling. But given what is happening globally in terms of euro area crisis, I think that was not going to happen, and that is what has materialized. The basic determinants right now are the current account deficit, and that is really what's seeing the currency lose as much as it is. I think the key problem over the last week is that prior to the MPC meeting last week, the CBK had said that they'll sell currency directly to big importers. But the Prime Minister recently overturned that and said that he's committed to a free currency. And I think that confusion from a monetary perspective is impacting the currency. And more so, given that importers are expecting to buy from the CBK, and that being overturned, they've turned back to the banks, which have raised the rates. So I think going forward, what is really needed is cohesion in policy, and at least for the CBK or whoever monetary authority there is right now, to mold expectations going forward, and to be committed to a single policy rather than throwing many stones, hoping that one will land on the target.
Okay, Samuel, obviously in a market like this, it's really hard to determine where the profits are. As you said, look for some of the lowest valuations. It makes it cheaper to enter the market at this rate. But for somebody who's saying, I need to know which are the sectors, which are the stocks that are beating the market. Somebody is making money in this market, irrespective of the conditions. Where would that be? Where would those jewels be?
I think you'd start with the energy sector, especially through KPLC and Kenyan Market, because KPLC is naturally hedged because the ERC guidelines state that they can pass on forex losses to the consumers, and we've seen that through higher power tariffs. So KPLC is naturally hedged, and going forward, as long as electricity demand is rising, then you're going to see good revenues coming in from the company and hopefully good dividends. Kenyan Market is also naturally hedged, and there's been significant oil demand, especially given the demand for diesel-powered generators now that we've switched from hydro. I think those two counters would be a good suggestion based on the fact that they're naturally hedged and there's significantly higher demand for their services, for their products.